Here is a number that should terrify every short seller in Tokyo. $100 billion. That is the size of the war chest Masayoshi Son is reportedly finalizing this week for Project Izanagi. The sleeping giant of Japanese tech has officially woken up, and he's betting the entire house on artificial general intelligence.
$100 billion? That's bigger than the GDP of Sri Lanka. If Masa is back in deal mode, the whole Asian tech landscape is about to get very volatile. And welcome back to Asia Tech Macro. I'm Maya, looking at the innovation ecosystem, and with me is Alex, who is probably already calculating the net asset value discount on SoftBank Group.
You know me too well, Maya. But frankly, the discount is narrowing. We saw reports yesterday from Bloomberg and Nikkei suggesting that SoftBank is close to sealing a deal with Middle Eastern sovereign wealth funds to bankroll this massive AI chip venture. The goal? To build an AI semiconductor rival to Nvidia, using ARM's architecture as the foundation.
It's the Izanagi project we heard rumors about last year, but now it's real. I saw a note from Kirk Boudry at Astris Advisory this morning. He pointed out that with ARM's stock price holding steady above $180, SoftBank finally has the collateral to leverage up again. But Alex, isn't this risky? We all remember WeWork. Is this visionary Masa or gambler Masa?
That's the debate. But look at the macro context. Nvidia can't supply everyone. OpenAI needs chips. Google needs chips. Masa is essentially saying, I own the blueprint, ARM, now I'm going to own the factory. If he pulls this off, SoftBank stops being a telecom company and starts being the Berkshire Hathaway of AI infrastructure.
It's a bold pivot. And speaking of infrastructure constraints, let's look at the other side of the supply chain. While Masa is dreaming of AI chips, the factories that are supposed to assemble our gadgets are facing a nightmare scenario. Vietnam is flashing warning signs again.
You mean the power grid? It's 2023 all over again, but worse.
Exactly. Worse because the stakes are higher now. I was reading a confidential memo circulating among foreign chambers of commerce in Hanoi this week. It warns that northern Vietnam, where Samsung and Foxconn make half the world's electronics, is facing a potential 10% power supply deficit as early as March due to low hydro levels.
It's the infrastructure gap hitting the AI demand wall. You have these massive new factories moving in for the China Plus One strategy, all demanding 24/7 stable power, but the grid is still relying on aging coal plants and unreliable hydro. I saw a quote from a supply chain manager at a major U.S. tech firm saying, cheap labor is useless if the lights go out for 4 hours a day.
That is a brutal assessment. And it's not just talk. I saw data from the General Statistics Office of Vietnam showing that industrial production growth slowed unexpectedly in January. If they can't fix the grid by summer, we might see a reversal. Companies pausing expansion or even looking at India or Thailand instead.
Or, ironically, moving some capacity back to China, where the grid is rock solid. It shows that resilience isn't just about geopolitics, it's about physics. Speaking of physics and chemistry, let's look at Indonesia. They bet their entire economic future on one element, nickel.
The downstreaming policy. President Jokowi banned raw ore exports to force companies to build smelters locally. It worked for a while, investment boomed. But now the market has shifted beneath their feet. The price of nickel is hovering near multi-year lows and it's not recovering.
Because the battery chemistry changed. Indonesia bet on NCM, nickel, cobalt, manganese, which is the Ferrari of batteries, high range, high power. But the world is buying Corollas. The world is buying LFP, lithium iron phosphate,
which contains zero nickel. I saw a report from Benchmark Mineral Intelligence stating that LFP batteries now power over 65% of all EVs sold globally, driven by BYD and Tesla. If the mass market moves to LFP, Indonesia has left holding a lot of expensive, dirty nickel infrastructure that nobody needs as much as they thought.
Exactly. It's a classic tech disruption trap. You build infrastructure for yesterday's technology. I saw a very bearish note from a commodities strategist at Macquarie suggesting that Indonesia's nickel surplus could last until 2028. That is a disaster for their sovereign wealth fund plans.
So they are burning coal to smell nickel that is losing market share. That is a tough environmental and economic sell. But Alex, is there any silver lining? Or is the EV dream in Jakarta officially over?
Well, they are trying to pivot. I hear rumors they are courting BYD to build LFP plants there too, basically admitting defeat on the nickel monopoly. But they have to move fast. They do. And admitting you backed the wrong horse is the hardest thing for any government to do. That brings us perfectly to our contrarian corner.
All right, Alex, what is the consensus truth that you are ready to dismantle today?
The consensus is that Japan is the safe haven of Asia. We hear it everywhere. Stable politics, cheap currency, rule of law. It's the Switzerland of the East.
And you think it's not?
I think that in 2026, Japan is actually the next emerging market, not in a good way.
Wait, what? Emerging market?
Look at the volatility. Look at the tourism dependency we talked about last week. Look at the fact that Masayoshi Son is betting $100 billion on AI chips because the domestic economy offers zero growth. Japan is trading like an EM, high currency volatility, foreign capital dependency, and a barbell economy, either ultra-luxury export or subsistence domestic. The safe haven trade is over. Now it's a high beta trade on global tech.
High beta Japan. That is going to make some pension fund managers very uncomfortable. But looking at the yen swings this week, I can see your point. It behaves more like the Brazilian real than the Swiss franc these days.
Exactly. Now, let's wrap this up with the action items. What should our listeners actually do on Monday morning? Action item 1. If you are long SoftBank Group 9984.T, watch the NAV discount. If the Izanagi deal is confirmed, the discount should narrow significantly. But be ready to trim your position if ARM starts to wobble. SoftBank is basically a leveraged ARM ETF now.
Action item 2. If you have supply chain exposure to Vietnam, diversify your energy risk immediately. Install backup generators or solar panels for your factories in the north. Don't trust the government assurances about the grid for this summer. The data says otherwise.
And action item 3. If you are trading battery metals, short nickel futures or the miners. The structural shift to LFP is accelerating faster than the market realizes. Indonesia's nickel surplus is not going away in 2026. Look for lithium miners instead if you want EV exposure.
Great insights today, Alex. We covered Masa's $100 billion gamble, Vietnam's power crisis, and the nickel crash.
It's a wild world out there. Next week, we're diving into the Indian IPO boom and why Mumbai might be the only capital market that matters this year.
I'll bring the data, you bring the skepticism.
Deal. Thanks for listening to Asia Tech Macro. Don't forget to subscribe on Spotify or Apple Podcasts and leave us a review.
Stay data-driven. See you next week.
Bye.
Bye.